thank you so much for coming out to the podcast. This is the HomeLord Podcast, and we're happy to have you. This is Jake Garrick, and I'm going to kind of toss the torch over to you, and I'm going to let you introduce yourself because this should be a super exciting one.
Yeah, appreciate you guys. Good to meet you, Joel. Good to see you again, Justin. My name's Jake. Like you said, I've been in the cost segregation world for a handful of years at this point. I own a company called Lane Cost Segregation, so that's what we specialize in specifically is saving real estate investors money on their taxes, whether they're house hackers, big commercial investors, everywhere from a small investor that's just starting out to large real estate moguls. Anything that we can do to save them money on taxes is what we're worried about.
So everyone needs you is what you're saying.
Yeah. That's I think so. Not everyone seems to agree with that, but I feel like that's the case.
Okay.
Which is wild because as we go deeper into it, it just blows my mind that people don't realize what it is that you provide. Like it just blows my mind that people don't get it.
Okay. And the emphasis for this podcast has always been like house hacking, and then we'll dive deeper into what cost segregation is. So how did you first learn about house hacking?
Sure. So house hacking, the actual name itself really was introduced to me by Justin. I knew what it was. Obviously, I know that there's certain business use percentages that can be placed into service, even within your primary residence, whatever it might be. But, Justin really putting an emphasis on it, him being on my timeline, us having a prior relationship has really brought that to a little bit more of an in-depth knowledge for me of what it looks like, how you can leverage it to get into the real estate world. And then when it comes to cost segregation, getting a little bit more creative as far as utilizing only the in-service or business use percentage of a property and doing a study on that rather than the whole building itself.
No, I think that's awesome. So, I think it's definitely great because you've helped me cost seg my property and it's been wonderful. I've loved it. But the question that I would love is, sorry, I need to read my own writing. So basically, if you were to take what you do into its simplest form, how would you describe it to somebody who has a very limited knowledge in real estate?
Yeah, great question. So when you purchase a property, the IRS recognizes it as either 27.5 or a 39-year asset as a whole, right? So if it's a residential property, it's a 27.5-year asset. It depreciates 1 year at a time. Throughout 27.5 years, you get 1 year's worth of depreciation, and you can claim that on your taxes each year moving forward until it's fully depreciated. Same with commercial, it's just 39 years. So what we do in cost segregation is we don't look at the building as one singular asset, but we look at it as all of the individual parts that make up that asset itself. So there's so many different assets, even in this room or in any property that you see, that are shorter life assets, such as carpet, flooring, specialty lighting, cabinetry, countertops, window coverings, things like this are 5 or 7 year assets, all identified by the IRS that way. Or for example, there's 15-year assets on the outside. So any landscaping, curbing, trees, gutters, shrubs, things like that are 15-year assets. But the IRS has no way to distinguish or to separate all of those assets out individually so that you can depreciate them over their correct lives. So they leave it all in the 27.5 or 39-year bucket, which essentially is cutting you guys short, or the real estate investors short, on how much money they're able to depreciate each year.
So it's the funny way that the IRS wants to make you pay more in taxes.
They just don't want to have to put in more effort than they need to, and that happens to benefit them. So, kind of makes sense on their end, and I'm glad because it gives me a job. So.
All right, so I'm going to ask you a question because I've sent you to some people and we've taught classes about this together.
Sure.
And one of the questions that I feel like I get almost every time, and it makes me chuckle every time, and it's not on the prompt or anything, but is what you do legal and moral? Because a lot of people seem to ask that. But what would be your response?
It's funny because people who aren't familiar with cost segregation think that we are just somebody who's trying to scam, who thinks they've come up with some loophole. It's honestly not a loophole at all. Like in the IRS tax code, there's an audit and technique guide where it literally outlines every individual asset, the year life that it's supposed to be depreciated over, if it's, being done correctly. And we just go directly based on those tables that are put out by the IRS. There's a lot of calculations and engineering that happens on the back end, with regard to being able to identify the specific assets, how much money each of those assets are worth, comparing flooring, types of flooring and which ones are more valuable, things like that come into play. But in a nutshell, this has all been laid out by the IRS. Not everybody has heard of it. Not everybody is familiar with it because it recently came more relevant with the Tax Cut and Jobs Act in 2017 first, which is when bonus depreciation came into play at 100%, which we can get into more. And then more recently with the One Big Beautiful Bill Act, it came back to 100%. So it's really powerful stuff for real estate investors.
Huge.
So,
And it's completely legal.
yeah.
I was going to say I always like to start there because when we start getting into it, people really do respond by saying, this sounds just too good to be true.
Absolutely.
And it's just like, I mean, we
Which
can
it does.
give you all of the information that you want on it. Like there's no shadiness with it.
Right.
It's just, you have to understand it. And most people don't.
And from what I've seen, it's the single best way to be able to offset your taxes in a large lump sum, a very significant amount through one process of cost segregation. And, so I understand why people are skeptical, but there's really nothing to be worried about.
So let's debunk another myth. Cost segregation, can it be used for a first-time house hacker? And it can be used for someone that buys like a $20 million commercial property. It can be used for either.
Yeah, so it's kind of a loaded question in the sense that you can do a cost segregation on any property, regardless of basis, regardless of purchase price, size. Really, all the cost segregation means is we're going to split up all the assets into individual assets rather than leaving them as one singular 27.5 or 39-year asset. So that being said, is it always going to make sense? Potentially, no, right? And I would say at the point when it starts making sense is when the basis of the building or the property we're looking at is over $100,000. And that's when, things like 100% bonus depreciation comes into play, because that's what allows it to be significantly beneficial. And I know that's kind of a long answer to your question, but things like a house hack, the reason why they could potentially not be relevant when it comes to cost segregation is there's just not enough basis involved in the property. For example, if only 20% of your home is in service and it was a $300,000 home in the first place, there's not a lot of meat on the bone to work with to be able to create a benefit to make the study worth it.
100%. And it's a good reminder that it really boils down to two things. One, it can work for a small investor. It doesn't have to be these huge moguls that buy these like multi-tens of millions of dollars of buildings.
Absolutely.
But it can work for someone with a house hack. But everybody's situation is so specific that you just need to verify with like your accountant or with your tax guy or whatever that looks like, because you wouldn't want to spend money to not have it be worth your while,
And the last thing we're going to do is sell a cost seg study to somebody who's not going to be able to use it. And I think it's important to call out in this scenario, we did a house hack, or we did a cost segregation on your house hack property. And the reason it was beneficial is because you have real estate professional status. So a long-term rental versus short-term rental creates the question of, if you're a real estate professional, you can offset both active and passive income in a long-term rental. If you're not a real estate professional and you have a long-term rental, you can only offset passive income, which makes it far less beneficial for individuals.
Right.
Makes it tough for a lot of house hack situations. Short-term rentals opens the door for material participation, which again unlocks offsetting both active and passive income, which again I know is kind of confusing, but
but that's why you're here, is to make it not confusing.
Yeah. So I want to ask, because for people like me who don't fully understand cost seg as much as you and Justin do, like, what's the most common situation of someone who's like, hey, Jake, I need a cost seg because of X reason? Is it the professional real estate status group of people, or is it a different category?
Great question. So with residential properties, I think real estate professional status comes into play much more. That's basically the key to unlocking the power of cost segregation in the residential world. So real estate professional status is really relevant there. When you're talking about commercial properties, we're working with much larger numbers. You don't have to worry about that as much. It's going to be extremely beneficial in almost every case, assuming you're holding on to the property long term. So to answer your question, I would say people that are coming to me consistently and that utilize this as much as possible are people that are adding to their real estate portfolio every year and continuing to hold those properties as they're building their real estate portfolio. So if it's a quick flip and we're trying to pull the lever of utilizing depreciation, you're not going to be in the property or own the property long enough for that depreciation to happen. So it doesn't make sense for us to really go in and organize how everything needs to be depreciated, because you're moving in a year anyways. So why does it matter if it's a 5, 10, or 15-year asset? You know what I mean?
Right.
What is the trade-off of doing a cost segregation? Because it sounds like the intent is to be a buy and hold. But if I do a cost seg study and I want to sell 5 years from now, what are the consequences?
Great question. Yeah, so depreciation recapture is the big scary term that everyone runs into when they're looking into cost segregation for the first time, and they hit this roadblock of, oh man, when I sell the property, I'm going to have recapture, which is this big scary thing. When in reality, what we've seen is in most cases, if you're going to hold the property for at least 1 to 2 years, you're going to be totally fine as far as coming out in the green goes. It is potentially going to eat into some of the benefit that we've created with the cost seg, because you're paying some of that back, but the only amount that you're paying back is the amount that you weren't in the property to realize. So, say you buy the property, hold it for 3 years, all of the 5-year assets that we gave you benefit on in the first year because of 100% bonus, you really were only in the property for 3 of those 5 years. So why would the IRS let you keep that extra 2 years of depreciation?
Sure.
They're not exactly in the business of giving away money for free, and that makes sense, right? So there's a lot that comes into play as far as ways to offset that. For example, 1031 would defer that depreciation recapture, and there's a lot of real estate investors that continue to play that game. I'm not saying that's the best idea or the worst idea or even smart. It all is very case by case on if it's a good idea to look into something like that or not. But depreciation recapture is something that comes into play with a trade-off, I guess you could say.
So a 1031 exchange, which is basically selling a property and deferring the taxes, that's a loophole to not having to pay that recaptured depreciation?
Correct.
Interesting.
Yep.
There's some cool things, Joel.
Oh, I need to talk to Jake.
Yeah, you do. So then with this, because we've talked about like house hacking, we've talked about cost segregation, and basically just the idea of saving on your taxes, because it's something that everybody knows is like a certain is death and taxes is kind of the joke.
Yeah.
And we try to pay as little of the taxes as we can. So what would be, when it comes to house hacking, and it doesn't have to be about taxes.
Sure.
But when it comes to house hacking, what do you think is the most underrated benefit of house hacking?
I think the easiest answer is it gets you into the world of real estate investing. It kind of allows you to dive in without having to take an extreme risk right off the bat. You're not betting the house on, well, you kind of are betting a part of your house, but you're not really risking everything to be able to get into the real estate world, hoping it works out. And if it doesn't, you're screwed. I've worked with a lot of people that have started with a house hack as their first investment that's led to, okay, I kind of understand how to do this now. I can do it with a property that's a complete rental, and that leads to more and more properties potentially into the commercial world. So I think that's the biggest benefit, and also just being able to move into a property that you wouldn't be able to afford otherwise is huge. I think that benefit, which is just extremely obvious right off the bat, is probably the biggest one. Is you get to buy a house. You get to invest in something that's going to appreciate in value and start building portfolio.
Because a lot of what you're saying is super well-rounded, and I love it because it's focusing on so many different aspects of real estate. And in your business and in my business, I feel like most people, because there are so many different benefits that you can focus on within real estate, most people tend to really gravitate towards one.
Right.
And it's cash flow.
Absolutely.
And I personally think that is the weakest of all of the benefits.
Sure.
So what would be your take on that? Why do you think people tend to always just immediately get drawn towards cash flow and they forget about all of the other benefits?
I think cash flow is important. It'd be dumb to act like that's not why we're in this game in the first place. We are trying to make money. Everybody's trying to make money. But, there's stability and comfort that comes from owning a property that's a big benefit apart from the cash flow side of things, right? And house hacking isn't something that has to be a stepping stone to something larger. It doesn't always have to lead to being someone, oh, I'm a real estate investor, this is going to be my full focus in life.
Right.
That's not the case, right? It's just I want to buy this property that's a nice property that's going to be comfortable for me and my family, and I can afford it because I'm able to put half of the property in use as a rental. And
right.
Why do we need to look at it as anything more than that?
And then you could potentially get extra tax benefit. You could get the appreciation of ownership. I feel like there's so many things, and people, they just leverage so heavy on cash flow. And I just, of course, yes, it's important, but there's often times that I run the numbers on negative cash flowing properties, negative $300. I'd pay $300 to own the property.
Sure.
And it would still, in my mind, outpace a 401k.
Sure.
Because that $300, that's going straight towards my own principal, which is it's just money right back in my equity. Whereas my tenants are paying 100% of all of my interest expense.
Yep.
So even though it's not cash flow, you're still getting the equity. You're still making all these payments. But then people, what you do is just mystical for most people is the best way I can say it. They don't even think, unless they're like really involved with it or their accountant tells them to. I just feel like those benefits get swept under the rug and people focus on almost the wrong things.
Honestly, the term cash flow is kind of annoying. It's something that comes up constantly in the investment world. Like you'll even see on a listing, like it cash flows immediately. It's cash flowing right now. What does cash flow really mean, though? Are we only worried about the number being green when you look at the spreadsheet, or are you worried about, is this something that's going to set me up for progress in the future? Are we worried about something that has other, fringe benefits that aren't exactly dollars in your pocket, but create other opportunities for you? You know what I mean? Like cash flow in the sense of it makes, black and white, where it makes more than you're putting in every single month, obviously is important, but it's not everything, like you're saying, especially when you think about the tax benefits, which is kind of all that I think about. So it's a little bit unique in my scenario.
I think a lot of people assume like there's this whole like I want to retire and have something pay me and do no effort, and they attribute that to this whole cash flow thing, and it's so short-sighted because real estate long term, like that really should be your focus.
That's where the money's made.
Honestly, my hot take, and this could probably have its own freaking podcast episode, is I think the people that have that focus are the people that will almost never get it, because they're so focused on finding a cash flow, air quotes, positive property that they're looking for like a 10% cash on cash return, which is great. They can find a house that would do that, but you give up some of these other benefits. Like it could paper at 10%, but maintenance would be through the roof. So your actual realized is like 2%.
Well, you have to consider, why is this house on the market in the first place if it's cash flowing that well? Like they're not just going to give up something that's paying them for free, like you're saying. Like,
or the home is just not going to grow in value, like hardly at all. Like, I mean, we lived in Kansas. Houses there, they're not too much more expensive than over a decade ago. But I mean,
people don't want to live in Kansas.
those $40,000 houses are now $42,000. So
but you're in the pursuit of this cash flow, you're giving up wealth. Like I feel like you're giving up dimes to chase pennies is what my attitude is, because there's so much greater potential for growth in the other aspects as well, that as long as you don't get one that's like bleeding like $1,200 a month or something absurd, it's still, I feel like if you just buy the right property, it's going to help you get to that retirement goal and all of those other things so much better.
And a lot of times you're buying a path to cash flow, right? Just because it doesn't cash flow immediately, maybe you're paying $300 a month, like you're saying, in the first place, but you have a 5-year plan that's going to lead to a point where it is cash flowing, and that rolls into other investments. So
and like we're based in Utah right now, and a lot of our listeners are Utah based, and if you look at like a $600,000 home at 2%, even like that's low. Like that's still $12,000 of like appreciation every year. Like you can't make that in Kansas or another place. So if you forego the cash flow mindset and focus on appreciation and everything else, like you're gonna come out on top. Like huge. Like it's crazy, and people just don't understand that.
And the way that I point it out to people is like right now, if you're trying to buy cash flow, it costs a lot of money up front to buy cash flow. Even if you buy out of state and it's like some janky property or whatever that has the cash flow, like you're still going to spend like $40,000 or something on that. But if you put that same money towards something here in Utah that didn't cash flow positive, you paid like $300-$400 a month for it. Over the next 10 years, if you kept that, rents would still raise, you'd eventually break even, possibly cash flow by the end of that 10-year period, but you have 10 years of massive appreciation. Whereas this other property that was cash flowing, you have 10 years and the appreciation is so much smaller that when you go to sell the Utah property, you have enough cash that you could probably roll it over into another property and put 70% down. and then you literally will buy your cash flow,
300%,
but you'll get so much higher percentage. It's just, I don't know.
Yeah. And along both of those lines, my favorite scenario to see is a situation where the appreciation is real, like you're saying, potentially 12 grand a year in your scenario. And you're taking advantage of that just by owning the property, but you're also taking advantage of depreciation at the same time.
Yes.
So it's appreciating and depreciating at the same time, both of those things putting money in your pocket, which is awesome, right? So, you know, it's kind of crazy to think about, like, because that doesn't work on paper, right?
Your property goes up in value in reality, but on paper it's losing value.
Exactly. Yeah, but it happens all the time. I mean, that's basically the best case scenario for my clients. So
yeah. But honestly, that's what I love about this whole topic is what you do is you focus on all of the other kind of benefits outside of just this cash flow monster that's trying to eat everybody alive.
Sure.
Like you're actually showing the utility behind why real estate is a powerful investment, because if all it was cash flow, real estate would not be a powerful investment.
Yeah.
It's all of the other things that work in the background that actually make it what it is. So
yeah, totally agree.
But
yeah, that's pretty much my thoughts on that one.
I like it. That's great.
So I want to know from your perspective, because obviously you're very well spoken. You understand what you're doing. We share a lot of the same barriers of like there's an educational gap, but as soon as they understand, they're more willing to house hack or do a cost seg study. So my question to you is, what is your number one tip to someone who wants to get into house hacking for the first time that has these fears or lack of understanding?
So it's funny because I don't think cost segregation is the answer. You know what I mean? Because if you don't have the money in the first place to get into a house hacking type situation, you're probably not going to have a tax liability that's significantly high anyways that you're going to need to look to offset with something like cost segregation. So I don't know if I'm necessarily the right person to be giving advice in that scenario, but you know, I do have people like Joel and Justin in my life who I would kick those people back to and say, hey, I'm going to stay in my lane with regard to cost segregation. When you do have a property, you come to me, I'll show you how to save more money. I don't know if I'm the best person to be telling them how to save their money initially to get into a house hack. Just being fair, you know what I mean?
But when they move up and into their next home, that's when they're like, hey, now I got this whole big old property that I want to realize now.
When you're ready for your investment situation to snowball and to really start making significantly more money, that's when I come into play. And that's when you refer them back to me. And that's what I love about relationships like this.
So freaking cool.
That's awesome.
Yeah.
Okay.
Awesome.
So that didn't really answer your question. So
It worked. No, that was great.
I just don't want to. I don't want to be giving advice that I don't know if I'm the right person to be giving it. You know what I mean?
I just want to call out something really cool about you too. Is one of my biggest pet peeves with like some businesses that are so salesy. They don't care about the client to the point where if it's not good for them, they'll still try to sell them the product or service. You're very much like, I will not do it unless it makes sense for you. So that speaks volumes to you as a person and your company. I just wanted to call that out.
Oh yeah, it's like
I appreciate that.
It's like 50-50. The people that I send to you and that I recommend to you, like 50% of them, you're like, oh no, I actually think we can help them. And then the other 50 is like, no, it doesn't make sense to, so we're not.
Right.
And it doesn't cost them money to figure that out.
No, and that's really important to understand is it doesn't take a lot of work on our end to be able to determine how much you're going to make with a cost segregation study. I really need some very basic info, things like address, purchase price, in-service date of your property. That gives me enough information to say, hey, we're going to save you exactly $56,000 in taxes this year, and that's real money, So it's very easy at that point to determine, oh, I'm going to pay this guy, $2,000. He's going to save me $56,000 on dollar for dollar tax savings. Why wouldn't I do that? You know what I mean? Or I take a look at it and I'm like, you don't have the tax liability. I understand why you want to look into cost segregation because it's the cool hot topic in real estate, but it doesn't make sense yet. That doesn't mean it won't in the future, and that's always true. There's so many people that I've turned down, like Justin's saying, where it doesn't make sense at the time, that have gone on to invest in other properties that are a little bit more, that cost a little bit more, that were in service at the right time, where they are able to take advantage of it.
Okay. Very cool. All right.
So, yeah, I think that's a great answer.
Yeah, that was fantastic. Well, thanks for coming, Jake. This was awesome. I'm getting your number after this too, by the way. We need to chat.
Well,
but yeah, we should definitely have you on again.
let's do it.